You're listening to Southeast Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Challenge us at Wexford Insurances 0818 31 30 30.
John Mackey from Bibby Financial Services joins me in studio now. John, before we discuss invoice discounting, I know you are an Enniscorthy man. So tell us about the path which took you to your current role.
Yeah, born and bred in Enniscorthy. I did my leaving cert in 95 and did a business degree in DCU. Qualified in 99 and joined Bank of Ireland Commercial Finance. I stayed there for 3.5 years and moved on to Bank of Scotland, Ireland, all the time living in Dublin. In 2005, I had the opportunity to move back down home, which was always my wish. So I moved to the bank. There was an office, a Bank of Scotland office in Waterford, and moved down there and managed a portfolio of clients in the Munster and South Leinster area. And I basically I did that until it was the end of 2010. As people may know, Bank of Scotland closed down, and we moved into Certis, and I stayed there until June of last year, which time I joined Bibby as my current role.
So John, most of our listeners won't have heard, I would assume, of Bibby Financial Services in the past because you're not a high street lender. Tell me exactly who they are.
Bibby Financial Services is it's a worldwide organisation. It's just an independent provider of invoice finance facilities. It was set up about 30 years ago as part of the Bibby Line Group, which is a family-run business in the UK. It's a sixth-generation family now, chaired by Sir Michael Bibby in the UK. Bibby Financial Services Ireland was set up in 2006, and at the moment now we have 30 employees. We've grown to that level.
So your products, you have two specific products: invoice discounting and invoice financing. For the purpose and benefit of our listeners, would you go through exactly what those two products are and what the difference is between them, please?
Yeah, well, I suppose in essence the two of them are the principles of them are the same. What we do is you fund invoices basically in advance. So if you have a business that raises an invoice and sells on credit, basically what we can do is we fund day one when the invoice is raised up to a maximum of 85% of the value of the invoice, and basically then when the money is paid by the debtor, the money comes directly back to ourselves through the facility, and the difference then, the 15% or whatever the difference in the percentage, is paid back to the client. The difference between invoice finance and invoice discounting is that the invoice discounting is a confidential facility. So the client's debtor is not aware that the facility is in place, and that the facility is structured in that way that maintains the confidentiality of it. Invoice finance in its nature is basically the debtors are aware, and generally Bibby also provide an credit control function element to the facility as well. So typically the invoice discounting facility can be more suited to maybe a more well-established business with a strong debtor book, with a strong balance sheet and a profitable trading, whereas the invoice finance facility, where Bibby ourselves prefer to have more control over the facility, is that it's more suited to start-up businesses, maybe businesses that are in just kind of a turnaround stage. We can fund businesses through examinership, receivership. So it's that, or basically maybe if you have, there's just different aspects to it as well, like concentration. If you have maybe one debtor ledgers, that basically the invoice finance is more suited to that, whereas Bibby as a business, we just need a tighter control on it and a more manageable and a visibility of the control on the I suppose of the trade and the invoice and the collectability of the invoice.
John, am I right by saying that these services, that these two particular products are aimed at B2B service providers?
Yes, it is. It's business to business selling. But we don't fund private business selling to private individuals purely on the basis that there's just you cannot get a credit rating on a private individual. So really, it's business to business.
These two terms would be quite new to lots of our listeners: invoice discounting and invoice factoring. And many of our listeners today that are in business might feel that, how is that relevant to me? And are they of a size that they can actually benefit from a product like this? Yeah,
well, I suppose looking at the product in general, the product is suitable to really the two main criteria that we always look for initially are basically is the invoice in arrears, i.e. is the work completed that relates to that invoice, and is the invoice contractually complete? In other words, that it's not a form of a staged invoice in a larger contract. Really, if it meets those two criteria initially, then it's suitable. We say it's suitable initially. Then, obviously, we look at the broader picture as regards the viability of the business. You're looking at the strength of the debtor. You're looking at different aspects, of the business itself. So, really, and that would determine then of what product it goes into, as I was saying, if we'd recommend it for an invoice discounting or an invoice finance facility. So, really, like what we look at first, you're really looking at the strength of the receivable initially. And that's why you're looking at the audit trail of that invoice, the backup to it. How, quite simply, with invoice discounting, the way it's structured is determined of if we funded an invoice today. So if we paid out a client 80% of the value of an invoice today, and if the business went bust tomorrow, quite simply, would we still be able to collect that invoice? Now, fair enough, we may have to wait 60 days to collect it, but is that invoice still collectible? And really, in essence, that's what makes a business, if the invoice is in arrears and contractually complete, that's what makes it suitable.
Invoice financing and discounting, it's probably a great product, and a concept for the times we're in, because so many businesses out there today are suffering from cash flow issues. And what it's doing is it's providing business with cash flow lifeline up front, instead of them having to wait the normal 30, 60 or 90 day period to get paid.
Yeah, no, it's totally true. And I think that at the moment as well, that like what we hear continuously is that businesses are finding it difficult to raise cash through lending, and I think that at the moment that it is, and it's public knowledge and it's well known that it's very difficult to raise your overdraft or to get an overdraft or a term loan approved at the moment. And through invoice finance, you're actually releasing funding that's tied up in an asset on your balance sheet, which is basically your debtors. And typically, as you were saying, Karl, that you're waiting your 30, 60, 90 days to get paid your cash. What you're doing is you're releasing that cash that's tied up, and basically allowing a business to grow. And typically that's what invoice finance traditionally is. It basically it's a facility that allows a business to grow, because as your business grows, as your debtor book grows, the facility limit grows with it. So it's not like if you're looking at, if you were giving a term loan to grow, to set up your business and to grow it, you're always going to use that. Once you utilize that balance, basically you're stuck and you can't grow any further. Whereas with invoice finance, what you're doing is you're funding the invoices. You're releasing cash on the level of invoice that you're doing. So that cash is obviously constantly, if you're growing business, the level of invoice is increasing, your debtors ledger is increasing. So the level of funding that you're being provided with is constantly increasing. And that slope, that increase in the facility, that makes it ideal for businesses helps businesses to grow. And basically it provides that cash flow that is necessary, as you were saying, that is difficult to come across at the moment.
Is there a minimum monthly invoice amount that a business must be processing for Bibby to, I suppose, facilitate this? Yeah,
well, I think there's no rules, and there's not put down on paper that you have to be turning over a minimum of this. But I think generally you're looking at a business would need to be turning over between 200,000 and 300,000 a year to justify a facility from a cost perspective. But at the same time, like, we would fund businesses, so we'd fund start-up businesses, but obviously they would be structured in a way that we would expect by the end of year one that you'd be looking at that level of turnover.
Is it difficult for a business to become approved for invoice discounting?
No, not at all. Like, as I said, I touched on the criteria that we look for as regards, like, the main thing is the strength of the receivable. And that's what we're looking at. Like, so obviously you're looking initially at the backup to the invoice. And then, as I said, the strength of it also relates to who you're selling to. So, after that, and I said also that obviously we look at the viability of the business. But what we do is, I said, with that information, generally we're looking at the financials, we're looking at the debtor's ledger, we're looking at your invoice and backup. Once we can get that information, we can very quickly, within a day, come back to you and say, listen, yeah, we're in a position to provide the facility, or unfortunately some cases we're not, but at least we have that speed of decision making that we can come back and say that yes, that the facility is in place.
And tell me this, for companies out there that are approved for invoice discounting, is there a high level of administration to support this on an ongoing basis required?
No, not on an ongoing basis. The facility is run through an online website. It's a function. So as regards paperwork, and traditionally, I suppose, going back when I would have started in the invoice rent, there was people who was faxed, and even people used to come in the post and deliver it. And that, as I said, thankfully, those days where you were boxes and files, and it was incredible, like the amount of paper was involved with it. But now everything is done online. There's no paper. It's a paperless, transaction. Everything is done through an online system and stored on it, and there's no really paper transactions.
Now, earlier we spoke about it being specific to the business provider. But tell me this, is it more suitable towards a service or product-based business?
Yeah, I suppose like, if you're looking at like obviously the product-based, where you're pretty much moving boxes, if we want to say, you're selling pretty very straightforward, because you can have a clear audit trail of that invoice. You have the product, you transport it, you deliver it, signed, invoices raised, transaction complete. So that's your kind of, I suppose, that's the on the service side of it. Sometimes service can not be suitable, because if it's say typically like maintenance service can be invoiced in advance, so, and it can be done over a year. So if there's a contract side to it, but at the same time as well, within service you can have maybe security, whereby it's signed off time worksheets that that's all invoiced in arrears, so that it is suitable. So I think really, when people always ask, like, well, what's suitable? And I think, and it's fair enough that people don't have that great knowledge of invoice finance. And it's easy for me, I'm working in it the last nearly 15 years, but a lot of people don't. But really, the first thing to think about is the invoice in arrears? Is the invoice contractually complete? And basically, as I was saying, that if the business was to close down tomorrow, unfortunately, that's always worst case scenario, but unfortunately that's the way we have to approach it. Would we collect our money, and would we get paid back on the invoice? And if you can answer yes to those questions, we're the starting point. And basically then, like, I would say 9 times out of 10, even more, 99 times out of 100, there is a facility that we can structure and we can put in place for a business.
John, I'm sure there'll be people listening to this morning's show in business that are involved in the export market, and they'll be wondering if this facility is available for export debt.
Yes, of course. I suppose the fact that we touched on earlier, that Bibby, that we have a presence across Europe and pretty much across the world, that gives us comfort in funding transactions pretty much globally across the world. So pretty much we treat export debt in the same way as we would treat domestic debt. I can give you just a quick example. I won't give the company names. So we funded a business recently who import it's a component. They have the agency in Europe for a component of basically a part that goes into a Dell computer. And what they were doing was, it's a one debtor business. They sell to a preferred supplier to Dell in Poland. Basically, so what our client is basically is just selling this. They have they sell to the customer in Poland, who then supply on to Dell. Through the controls, we were able to put our certain controls in place. It's a disclosed facility. The debtor is aware that we're providing it. And that is, it was a 700,000 facility, and we were able to fund 75% of the value of those invoices. And basically, through the facility, the business was able to grow to the level it's at today. And when we actually, at the moment, is 700,000. When we started, it was a 200,000 facility. And basically, through the cash flow that we provided, he was basically able to grow the business to the level that it's at today. But as I was saying, pure on an export, yes, we're actually a very export-driven business as well, and we're targeted on the level of exports that we can fund. So it's definitely something that is very much suitable for. John,
is this facility more suitable to a company that has 1 debtor, 10 debtors, or 100 debtors?
Well, I suppose ideally, when we're looking at it, if you have a ledger that is well spread, like, so say if you have 10 or 20 debtors and they're all evenly spread out ledger, that's your ideal facility. Now, obviously, typically that's not going to be the scenario, so I think really what we do look for, and is one of the, I suppose, the risk factors when we look at structuring a facility, is the spread that there is in the facility. So the greater the spread, obviously, the lower the risk, because, you're spreading your risk across, obviously, a greater number. But as I was saying, the example I gave earlier, we do fund 1 debtor ledgers. We can fund 100 debtor ledgers, but it's really, as I said, ideally you're looking for a good spread, but we can structure facilities for all concentrated ledgers.
Now, you mentioned earlier in the interview that Bibby set up in Ireland back in 2006. I'm interested in hearing how your own book of business has performed since then.
Yeah, well, I think, obviously, like with the rest of them, I think 2006, 2007 and even 2008, we were heavily concentrated to a certain extent on the construction sector and businesses involved in the construction. But a group-wide decision was taken around that time to try to dilute the level of concentration that we had in the construction sector. And we successfully did that. And as the same as other people, we had our hits that we took in the following few years. But of invoice discounting. Invoice discounting is, I suppose, it's regulated by a body. It's called ABFA. It's the Asset-Based Funders Association, and basically they produce quarterly stats, and through that we can see what our market share is. So as a provider, we're doing very well.
I know another concern for business owners out there today when they're considering choosing a financial intermediary or a financial organisation or institution to deal with is this company here to stay? Because I think there's been lots of companies and lots of businesses left down over the last number of years where facilities have been pulled away from them because that particular lender was either moving out of the market or moving out of that segment of business. Yeah,
well, I suppose to look at it purely from a personal basis, first of all, as I said, as I mentioned previously, I was with Bank of Scotland, and unfortunately Bank of Scotland closed down in the end of 2010. So I kind of experienced that where the financial institution pulled out of the market. And when I joined Bibby a year ago, it was definitely something that I also thought about myself, like, how long is this business going to be here? But I did a bit of research and looked into the background of Bibby and basically seen the size of it. Like I said, we started here in 2006, and now we have approximately 30 employees now and constantly growing. We're moving office at the end of next month, which is we're moving the same building, but we're office space is increasing by 50%. So the ambition is there, and we know from seeing and from going to world kind of marketing events and Bibby, the kind of Bibby meetings that we have like once a year that I've been to, and you can see the ambition that they have, and they are extremely progressive bank. And just the CEO of Bibby is basically a man by the name of Simon Featherstone, who is actually, he was the ex-head chief of Lloyd's, and he actually was headhunted by Bibby, and he left Lloyd's and set up Bibby. So that, I suppose, in itself shows like his also belief, and and it shows the direction and that the ambition that the company has.
You're listening to Southeast Radio's Business Matters with Karl Fitzpatrick in association with Wexford Insurances. Think Wexford Insurances for your business insurance.